And welcome everyone to another Smart Money Circle episode. I'm Adam Sarhan. With me today is Michael Bell, who's the founder and CEO of Meketa Capital and Primark Capital, he's democratizing private investments, has approximately 400 billion in AUA, which are assets under advisory, and about 500 million in AUM, which is assets under management. Michael, thank you so much for taking the time and welcome to the Smart Money Circle.
Adam, great to be here. Thanks for having me on.
So, Michael, I always like to begin. Can you please tell us your story and how you got to where you are today?
My backstory is I was born and raised in a small town in West Virginia, and that helped really kind of shape much of what I do today. Because I was in a fairly small town, the access to opportunity was a bit limited, and I saw that, and it was really hard to that kind of sense of maybe limited access or unfairness kind of shaped a bit of kind of who I am in the professional world today. And it really kind of really drove my sense of purpose, my sense of being. I was introduced to hard work kind of really early, and I saw how hard people had to work to really open up access to things that others had, right? And so that really kind of drives me today to really help break down those barriers. I ended up not really knowing what I wanted to do with my life when I grew up. So I went into kind of a couple of industries that were pretty broad. I was a CPA early on, based out of Washington, D.C., and worked for one of the, at that time, big eight accounting firms. And so my client base, I went to clients all over the region and even in Africa to learn about businesses and understand what they did and how they did it. And I then had an understanding of what I liked and what I didn't like, right? And then I took one step further and went into corporate finance, and I was a lawyer for, at that point, it was the largest law firm on the planet at Latham and Watkins. I still think they're probably up there at a pretty large firm, but really spent the 90s taking companies public. One of the really cool things that I enjoyed kind of at that phase of my life, very similar to kind of the CPA days, you would drop into a client for 3, 4, 5 months, really understand their story. This was back in the 90s where the theme was, you build a company, start up a company, go from a venture firm to an organization that is throwing off $30 million of cash flow, $40 million of cash flow. And then you do what? You go public. That was just the protocol. That's what you did. So there was this massive market of emerging companies that were growing and going public every week. And so you drop into these companies for 4, 5, 6 months, work with a small team of 20 people at the company, with the lawyers, with the investment bankers. It was side by side. You're doing something that is probably one of the most exciting things in the lives of these folks at this company, right? And many times we would go up and be on the floor of the New York Stock Exchange and watch that company ring the bell and go public. Super fun, super cool, and you would just see these companies kind of take off and grow. I did that for about a decade, and I loved it. Absolutely love what I was doing. But then that helped shape me too, because I saw all of the fun and excitement that these companies had, kind of taking this vision that they had, and then taking it and growing it in with the use of the capital markets, right? And so I said, it'd be cool to be on that side of the fence, to kind of watch these companies grow. And that really kind of sparked my entrepreneurial spirit. And so that led me in 2000 to leave Latham and Watkins after about a decade or so, and then jump into kind of the entrepreneurial pool and start to build companies. And I gave you kind of some of the history of some of the struggles I had, kind of growing up and having the opportunity to look at different companies, and that really kind of guided me in the direction of kind of a constant theme through some of the companies that I've helped build and grow. And that was really opening up access, democratizing access to investment vehicles or investment themes or investment strategies or investment products because it's so hard to do that, right? And so that has been the consistent theme since I jumped into entrepreneurship and launched five or six, seven companies over the last 25 years or so. So maybe a little bit longer than you expected, but that's my start, my story, kind of some of the grounding and foundation that I had.
I absolutely love it. So thank you very much for that overview. I have great guests on the show, and everyone's got a different story. So I love your story, and I love the evolution of how you went from step one to step two to step three, and where you are today with democratizing the private investments. So let's speak about that. Can you please tell us about what you do and your investment strategy, anywhere you want to go?
Sure. So I have, for the last 25 years, building companies, launching companies, and opening up access to investment themes or investment vehicles that previously have not been opened up for investment advisors or their clients, right? And so when you kind of look at that base, we generally look up market, if you will, into the institutional marketplace. And hey, what are some of the themes and what are some of the products and what are some of the exposures that institutions have available to them? And how can we take those products and exposures and themes and bring them down into the retail space for financial advisors, right? And so that's one of the things that has driven me. And over the last kind of 5 or 6 years ago, I sold an RIA business practice maybe 7 years ago. And coming out of the sale of that practice, there was a theme that was emerging. And I saw this theme really started to bubble up from end clients. And I, kind of called it the country club conversation. And end clients would come to their advisors with the conversation of, hey, I have a buddy that's getting into this new private investment or this private real estate deal or this private credit deal or this IPO. How can I do that? And we really, as advisors, as an advisory platform, we really didn't have a lot of options available for that. Okay. Now, if you looked to the institutional marketplace, endowments, pension plans, and foundations, they have a lot of options that were open and available to them that fit this mold, right? So that got me thinking of, is there a way to democratize that? Something that's available for, these billion-dollar investors, and really bring it into a marketplace that I think candidly needs it more, right? So the 50 billion, the $100 billion endowment or foundation, they are fairly sophisticated, get access to anything they need, and they're getting what I call outsized returns, kind of on their investments. But those returns aren't available to retail investors who could probably utilize that just as well. And so got me thinking, how do we look at that? How do we marry that? So 6 years ago, 7 years ago, it was a bit of a bet in the marketplace of can we look at this demand that's really bubbling up from end clients asking for this? Hey, how do I get exposure to this? Um, and if we go out and build some products and be able to put it in their hands, is that going to be a little blip or is it going to be a trend? And so here we are, kind of 6 years later, and what started out as a bit of a bet 6 years ago has now shifted into a mega trend. Okay. And that mega trend is really opening up and democratizing private investing for retail investors. And when I say private investing, private markets, I mean private equity, private credit, private infrastructure, and private real estate. Okay. Those asset classes have been around for 30, 40 years. Okay. But they haven't been available for retail investors except for the last 3 or 4 years, okay, because of the structure and making that available to the retail marketplace. So that's where I've spent my time. That's really the passion that I've had. It kind of ties back, candidly, to some of the access and struggles that I saw early on that really shaped me, and really understanding how hard you have to work to be able to get that access to something that may feel out of reach. And now we're able to take investment themes, investment strategies, and package it and make it available to retail investors really for the first time. So when I talk about this mega trend shift, Adam, so if you look across the wealth management space, financial advisors and their clients, currently, if you just look kind of across that entire spectrum, on average, they have 2 or 3% of their assets allocated to private market assets. That is going to trend to over the next decade, decade and a half to 20%. When you go from 2% to 20%, that's a tenfold increase in exposure. And so as a result, there's a lot of activity in the space from a product development perspective. A lot of traditional firms are moving into the space. And I think, and they're leading kind of with education, which is going to be incredibly helpful for advisors and their clients as they move through kind of this trend.
No, I love that. So I have a concept in my book actually that's called intellectual arbitrage. So it sounds like that's what you're doing, where you're arbing the situation where the institutions in the past had access to these private investments. Most of the investment world, the retail and RIAs, which are a big part of our audience, independent money managers, don't have access. So what you're doing is bridging that gap and saying, okay, folks, here you go. Let's get access to the same investments that provide these returns that these big institutions are doing. Endowments all invest in private investments, to my knowledge, so on and so forth. Is that a good way of summarizing it?
That's exactly what it is. So if you look at, take one of the asset classes, private equity, for example, the over the last, couple of decades, private equity has returned kind of in the high teens, kind of, 16, 17, 18% returns in private equity. Okay. If you look at the retail kind of public equity markets, it may be 8, 9, 10% returns. So massive difference between an 18 and a 10, right? And so the institutions get the benefit of the private markets, but the retail investors are only they only have access to the public markets. So how do we break down those barriers? How do we democratize that? How do we look at what some of the smartest and largest investors take advantage of in the marketplace, and how do we make that available? And so that's been the challenge. And there have been a lot of really smart firms, entrepreneurs rolling up their sleeves to be able to package these assets into structures. Typically, those structures have taken the shape of funds that look and feel, they're similar. They have characteristics of mutual funds. They're not exactly like mutual funds, but they have characteristics of mutual funds. So they make them easy to execute on for retail investors. And they're packaged in a structure that again eliminates some of these high investment minimums, that eliminates some of the high fees that institutions typically have to pay, and that actually provides some liquidity in those products. So your investment's not locked up for a decade or so. So breaking down those barriers, addressing kind of those hurdles to entry into the marketplace has really helped this intellectual arbitrage to bring these products and hopefully bring the same risk exposures and risk adjusted returns into a new marketplace, opening that up for new investors.
Yeah, it's brilliant. It makes perfect sense. So thank you for that, Michael. Next question for you. Let's talk about risk. How do you handle risk? What are some lessons you've learned about risk management over your career and that you'd like to share with the audience and anywhere else you want to go with respect to risk management, please?
Sure. So, I think anybody that's getting into investing, the best way to manage risk is by looking at your longevity kind of in the market. Okay. If you're in the market for quick kind of in and out, and you're a short-term investor, the investment marketplace may not be the place for you. Okay. It may not be a good place to invest. Okay. Because, it's hard to compound and grow, what you don't really protect. So, the first job as an investor is to, kind of look at your risk profile and understand what makes sense for you. Everybody's risk profile is different. Everybody's risk number is different. And so I think if you're going to invest in the markets, whether it's public markets or whether it's private markets, it's a long-term initiative. It's a long-term endeavor. If you are hyper-focused in looking at your portfolio on a daily basis or a weekly basis or a monthly basis, that's going to drive you crazy. Okay, that's that volatility kind of in the marketplace has a tendency to do that. So to take a long-term view, you have a tendency to mitigate risk from a very long-term perspective. But so as we like to look at it, risk is something that you respect. You don't fear it, but you just don't ignore it. Okay, but it's something that you do have to respect. And so, how do you respect that, and how do you address it? So you can diversify your risk through the vintage year that you invest in. Okay, through the manager selection process, who you invest with, through the sectors that you invest, and through the overall strategies. So diversification helps to mitigate risk. So number one, kind of a long-term risk horizon, and then true diversification really helps to mitigate risk over time. So and then I think maybe one of the bigger lessons there is having emotional discipline kind of in the investment process, right? And that is not being whipsawed by volatility that you see in the marketplace, by headlines that you may see that are popping up every single day, and just be disciplined investor with a long-term approach that helps to kind of mitigate risk, kind of over the long term. So, at the end of the day, risk isn't something that you eliminate. It's something that you do respect. And, in investing overall, you win by staying in the game, and I like to say that, longevity is the real kind of alpha in investing and in kind of risk mitigation.
I love that. So, in addition to intellectual arbitrage, I mean, we just met, but we could talk for hours. I have something called time arbitrage, which is
Right.
just to that point right there. It's Buffett says think in decades, not days or weeks or hours. Most people looking at an intraday chart and they just get caught up with their emotions and miss the bigger picture. All right, I
Right.
love it.
Well,
Thank you.
you mentioned Buffett, and one of the greatest investors kind of our time. Simple advice that you really have to kind of think about. One of the pieces of advice that really come out of Buffett investing is know what you're investing in. Right. And some people take that approach as to, yeah, I'm going to invest in Home Depot. So visit Home Depot and know what you're investing in. Are the aisles crowded? Is the parking lot crowded? Do you know can you explain it to your spouse? Can you explain it to your kids? Whatever. But know what you're investing in. And I think many retail investors have a tendency to forget that. For example, and they want to invest in the cool thing that's kind of in the market. So Nvidia, okay, so it's a $5 trillion company. What's it do? Do you know? Okay, if you know it, awesome. If you're investing in that theme and that thesis, you should be able to explain exactly what they do, where they generate value, and kind of what their contribution is to society, if you will. But the other thing that I think that gets missed, there are some investors that say, just invest in the overall market. Okay. But again, you have to know what you're investing in. Right now, when you invest in the overall market, okay, dynamics that have happened in the market, if you're just micro focused on, I'm going to buy, the S&P, okay, what's that comprised of? Okay. And do you know that, half a dozen stocks are driving most of the return in the market that's called the S&P 500? It is a collection of 500 stocks, but most of that return is being driven by just a few. Did you know that? Do you know what you're investing in? Right? Did you know? Okay, in the overall market, I told a story, when I started in public finance or corporate finance rather, that I took companies public. 20, 30 years ago, that was the dynamic. Companies grew, generated EBITDA, and went public. And that was just the process. 20 years ago, we had 8,000 publicly listed companies in the US. Today, the US market is 4,000 publicly listed companies. Half of the number of companies just 20 years ago. And if you don't focus on knowing what you're investing in, did you know that as an investor? I'm going to invest in the market. Now the market has shrunk by half. Okay. Why has that happened? Well, one of the things that's happened is one of the themes that we talked about, this private market investing. Companies like, 30 years ago that I took public, they don't go public anymore. They get $30 million of earnings and they still need capital to grow. Well, they now have a different outlet. They don't have to go public to raise more money to grow. They can go to the private markets and private equity and raise money that way to grow. So all of these, what you would previously consider 30 years ago, 20 years ago, these high growth companies, they're not in the public markets. They may wait 20 years to go public. And you've seen a tremendous amount of growth go through that marketplace or go through that individual company before they go public, right? Because they stay private. So that's a dynamic. So again, a Warren Buffett euphemism, know what you're investing in. And it's whether it's a company, okay, or it's the entire market. You should know what's happening with that entire market. So kind of an interesting dynamic that's happening now that most investors may not know about, but they should.
Yeah, no, I love that. Okay, thank you for that. Next question for you, Michael. What are some timeless lessons you've learned in life, business, relationships, anywhere you want to go that you'd like to share with the audience, please?
So, I think that in general, kind of over decades of time spent kind of in the markets, I think that the biggest lessons, they don't really come from a success, but they really come from, moments that kind of test your conviction, right? And the ups and the downs and the volatility in the marketplace. So you kind of look at some of the your returns are really generated not from timing the market, but from your amount of time that you're invested in the market, right? And so you can see that, you can feel that, you can write it down. It can be a thematic approach. But until you come to a market where there's been a 30% drawdown, okay, like we had in COVID or, kind of back in the, financial crisis, you test that conviction. Are you going to stay in the market? Okay, because your conviction is kind of long term. Your conviction is long term. You know that the best investors are long-term investors. Can you stay? Can you test your conviction? And can you stay in the market in, March of 2020 when it seems like what just happened with the world and COVID and the market's down 30%? Are you going to test your conviction and stay in the market? So when you have opportunities like that, that's where you learn. That's where the growth is, right? And I think that, one of those key lessons is, success is more about EQ, if you will, than IQ. And it's this emotional steadiness. Okay. Sometimes that emotional steadiness beats that, intellectual brilliance. Okay. You know where you want to be. You've looked at your investing approach and you want to stay true to that. Now, a lot of kind of volatility going on a day-to-day basis. Stay emotionally steady and test your convictions and move forward. So one of the kind of just themes in my life is relentless consistency. And so kind of a key theme there is that relentless consistency compounds. Okay. It's those small habits that you have, kind of your preparation, your communication, your follow-up, they create big outcomes, kind of at the end of the day. So it's kind of understanding where you want to go, being convicted, and really being very consistent, with that. So developing patience, okay, that's a skill, and being able to, learn to sit with that discomfort from an investment approach. You've done all the research, you've done all the work, you know where you want to go, and it doesn't feel real comfortable right now, but you have to trust, what you've done, and because oftentimes results lag effort. Okay, but it's that point of where that lag is where your character's built, right? And it's where growth kind of happens. So, confidence is important kind of in the industry, and you have to be convicted kind of with where you are. But the thing that really helps, I think, drive an investor forward and a successful investor is curiosity. And so it's one of the things that I've kind of learned is you always have to be able to ask the question. Like we talked about the markets, what's changed in the markets over the last 20 years? Well, the public market's been cut in half. Wow, okay, I didn't realize that. If you weren't curious about that marketplace and you didn't have a good understanding about that marketplace, you would miss that fact. Now, what are you going to do with that? You have to understand, the macro markets to understand kind of where you want to go. So, always be a student, kind of the markets, and always kind of understand, where you want to go. So, the wrap up, kind of some lessons learned for me anyway is, you know, consistency is underrated. Some people just don't like it. It's kind of boring, because I think the best investors, and this is your Warren Buffett analogy, they don't really chase excitement. They master repetition. They master consistency. Okay. And maybe kind of the second lesson learned for me really is, stay curious, Ted Lasso, kind of moment. And, the moment that you think you figured it all out, the market will humble you. You know?
No question.
So.
Yeah, no question about that. I love that. Okay, let's do the other side of that. Timeless mistakes. What are some that you've made, you've seen other people make, and how do you learn from them so you avoid them or don't repeat them?
So, I think you have to embrace mistakes that you've made and own them. And I mean, that's the best way to learn from them and not resist them. Yeah, again, that's some of that kind of emotional baggage that goes along. Nobody likes to be wrong, right? But I think embracing that is really where the growth happens. So you come up with something that may have been a mistaken call, that the time was wrong. I think you just have to look at that really from an unemotional perspective. When you detach from that and you look at it from an analytical perspective, you may have the right conviction, you may have had the wrong time horizon, right? But you own it, and it's not the end of the world. It is something that you learn from, something you have to put kind of in your backpack and carry along, kind of with you. Um, and understand it and learn from it. And it's interesting. So the platforms and companies that I've run, they've been through the great financial crisis quite some time ago, and one of the um, interesting points that I learned kind of in that is, we had a company and we probably had about $5 or $6 billion kind of at the start of the great financial crisis. And it was a platform that we provided investments and investment strategies for advisors. And all through that, the great financial crisis for um, 18 months, tons of volatility, tons of drawdown kind of in the marketplace. And we had thousands of advisors running, providing, $5 or $6 billion of assets on the platform that we were managing on their behalf. Many of them and their clients exited the markets as soon as you saw some volatility. Those we had, I think, 7,000 advisors that accessed our platform. Those that did the best disconnected emotionally. They looked at the market, they knew they had the right asset allocation, and they stayed true to investing. So we saw from a fairly broad-based pool of advisors and tens of thousands of clients, those that did well, and those that made mistakes by exiting the market immediately and never getting back in, or getting back in way too late after the market corrected, versus those that just kind of stayed true to their theme and their overall conviction. So it was an interesting approach where you could see a lot of mistakes, but then a lot of success, and you learn from that, right? And you have to take that forward.
Love that. Okay, let's talk about leadership. As a leader, and you've been around for decades now in this space, what makes a great leader? Can you speak a little about leadership and some lessons you've learned about leadership?
So, I think I always kind of lead with character and integrity. And I think if you use that as your guiding, your North Star, it's going to serve you well. As a leader, I've kind of learned to trust my gut feel, because that is where your character's built, right? People refer to it as your gut, but it's really kind of your heart. Does that feel right? Something feels wrong. Well, you're not trusting who you are, okay? Who your true and honest self is, and kind of where your integrity is. And so if something feels wrong, and whether that's hiring somebody, or whether that's firing somebody, or whether that's putting somebody and putting them in a position where you're really kind of having them grow and test themselves in a new position, or whether that's a new market that you want to enter into. If you enter it and you have a North Star, kind of a guiding principle of character and success, that will really set your path and really be a guiding principle for you. The other thing that I think I've learned that I probably underestimated early on was the power of relationships. Everything we do is built on relationships, whether that's on the kind of personal side or whether it's in business. And trusting, who to build a partnership with, or who to build a relationship with, is probably the most important decisions you make. And selecting your partner, kind of whether it's a spouse, or whether it's a business partner, or whether it's somebody that you want to develop a relationship with, selecting that partner is going to be some of the most important decisions that you will make, and that will really help give you a perspective of how successful you're going to be. You look around at the end of the day and look how big your tribe is, and the number of relationships that you have and you've built over time. That's really going to be a huge measure of your success. You look around the room and the as time goes on, who's in that room. I can tell you how successful you're going to be based on who's in the room with you at the end of your career.
Yeah, I couldn't agree with you more. The power of relationships is so powerful. All right, final question for you today, Michael. What is the best piece of advice you'd like to give the audience or your 30-year-old self?
My 30-year-old self. So when I kind of look at that, when I was 30 years old, I had a tendency to think, success was about speed, how quickly you could get kind of to the next level, take the next step and keep climbing the mountain, right? But I've learned, uh, over the last 30 years, it's really about endurance, right? And it's about that kind of relentless consistency. You keep doing something day after month, year after year, and you continue to do that. That is really kind of what's going to be your grounding for your character and your grounding for your success overall. So, some of the things that I would, as if I'm having a conversation with that kind of 30-year-old guy that, got a lot of energy, has a, kind of mission behind him, has had struggled with access kind of, early in life. And I would say, hey, look, don't really chase validation, kind of out there in any part of your life, but really build conviction, kind of around what you do and understand, kind of your character and your integrity. And one thing that I maybe ties back to a mistake, that I made earlier is, learn to say no early. I'm kind of a yes person. I think we all like to nod our heads and but saying no is more important, I think, than saying yes. That helps protect your focus, helps protect your calendar, helps protect your vision, helps protect you kind of knowing, kind of where you are. And I think, all of, kind of what I've been talking about is surround yourself with true relationships or friends that will tell you the truth. Okay, so, because sometimes that's hard to hear. It's hard to say to friends, but it's also hard to hear. And so I think that's incredibly important. And I think that maybe the last thing that I've kind of lived and learned, it's not something I knew kind of early on, is that for me, joy's in the journey. Okay, it's not crossing the finish line. It's not finishing the marathon and raising your arms and that's part of uh, joy. Okay, but what about all the time and training and work and effort and grind that you put in? So you have to find joy in that process. It's not just the goal line stuff that is is most important. So, I think, kind of overall, it's hard to build, kind of a long-term vision with short-term habits. So, it's something that you really have to work on, that relentless consistency, stick to it, and you'll be successful.
Well, Michael, thank you kindly. You've given us a lot of great timeless lessons here. It's packed the endurance, the relentless consistency, the long-term focus with the short-term, this, that, and the other. Phenomenal. So thank you kindly. Congrats on all your success. Hopefully we'll have you on us again soon. This was absolutely fantastic.
Loved it, Adam. Really appreciate just the opportunity to chat with you, and congratulations on the success that you've had here as well.
Thank you kindly.